If you ask any banking analyst where to find the safest, fastest growing commercial loans in India, they would point to places that don't look like typical banking hubs, but the data tells a different story. Right now, the fastest growing business borrower segment in the country is not large corporates or tech startups. It is comprised of rural and semi urban women entrepreneurs. This growth is concentrated in regions historically considered economically laggard. While southern states once dominated women's business credit, the heartland is now surging, with Uttar Pradesh recording a 59% compound annual growth rate and Madhya Pradesh following at 42%. Overall commercial credit is growing at 17%, while women's business credit grows at 31%. The 16 crore female borrowers now hold a 76 lakh crore portfolio. Shockingly, their default rate is just 0.7 times the system average, making them 30% more reliable than the average borrower. This demographic has moved past the era of social charity. Lenders now see a viable business case built on high growth and the lowest default rates in the Indian banking system. Reaching this segment required solving a massive structural problem. Government programs successfully opened hundreds of millions of bank accounts over the last decade. But a zero balance account does not automatically confer economic power. To qualify for larger loans, banks traditionally require physical collateral or tax records, assets that an informal vendor completely lacks. Without that paperwork, she remains economically invisible to the formal system. That invisibility is being erased by digital public infrastructure, the DPI stack. This ecosystem creates what analysts call synthetic collateral. The first layer is digital identity. Aadhaar based eKYC slash the cost of acquiring a new customer from 1500 rupees to under 50. This cost reduction made small ticket loans commercially viable for the first time. Then comes the transaction layer. Every time a customer scans a QR code, it captures the velocity of money. Daily sales that used to be informal and untraceable now create a verifiable cash flow history. The DPI stack translates digital hustle into bank credit. A vendor who was previously unbanked can now use her digital footprint to secure a collateral free business loan. While technology solves the assessment problem, it is a distinct behavioral discipline that keeps these loans performing at 7 times the average. Much of this discipline comes from self help groups. These rely on joint accountability. If one person defaults, the entire community loses its credit access. This is a discreet but powerful mechanism for social enforcement. Borrowing habits are also more conservative. These women tend to take loans strictly for productive purposes, like children's education or business working capital, rather than for speculation or consumption. There is also significant savings caution. Data shows women maintain stronger buffer balances, allowing them to ride out seasonal income shocks without missing a loan payment. The result is a clear pathway to growth. 19% of women who start with survival level microfinance successfully scale up to individual retail or commercial banking products, like the owner of a small trading business who enters the formal credit ecosystem through the intersection of verifiable digital transactions and strict social accountability. These women are turning previously vulnerable borrowers into the most reliable business builders in the country. On a macro level, India's female labor force participation currently sits at 37%, well below the levels of most global peers. If credit pathways can push that participation rate to 50% over the next decade, India would add an estimated $700 billion to its GDP. There are immediate threats to this expansion. The microfinance sector has recently contracted due to borrowers becoming over leveraged, and severe climate shocks are hitting rural incomes. Even with the progress made so far, a massive gap remains. Roughly 29 crore credit eligible women are still locked out of the formal financial system. Many of these women are nano entrepreneurs or informal domestic workers who lack Aadhaar or UPI footprints or the financial autonomy to make decisions without family permission. Capturing this segment requires lenders to move away from underwriting models designed for salaried employees. Instead, they must adopt flow based underwriting, using digital records like electricity bills and merchant UPI transactions as collateral. Solving the final mile for these 29 crore women has become a competitive race to capture the single largest untapped growth engine of the next decade. For the lenders who can bridge this gap, the prize is a $700 billion unlock for the Indian economy.